A long time ago, I met the head of the HMRC recoveries department, and he said, Keith, we'll support CVAs in the main, but we need to know what's going to be different. I always start with the diet and exercise approach. Can we do a deal that makes the creditors better off? Can the directors turn this thing around with our help? And each time he took out new money, it was to pay the interest back on the old ones. And it became a self-defeating spiral.
This interview is a bit different to the usual conversation that we have about business acquisitions. Today, I'm joined by Keith Stephen, a strategic turnaround expert and the managing director at RMT KSA, who has been in this business since 1995. Keith and his team have assisted thousands of distressed businesses, and they have helped them avoid liquidations and administrations. I hope that you enjoyed this conversation. When I had a look at the RMT KSA website, it said, like, one of the first things it says is it's a UK's leading experts in company voluntary arrangements, CVAs.
Yep.
For anyone who's watching right now who doesn't know what a CVA is, I was just wondering if you could maybe explain what is a voluntary arrangement.
Voluntary arrangement, I'll use CVA for the shortened version because company voluntary arrangement is quite a long phrase, is a scheme of arrangement or a deal between a company and its creditors to reorganize debt. And it could be reorganized in a discounted form. It could be that it's paid in full. But technically what it does is it takes unsecured debt and restructures it over a period of time. So that might include HMRC for tax, it might include trade suppliers, it might include landlords for rent, it might include redundancy costs, it might include a whole variety of things. What it can't include generally is secured debt. So secured debt in the form of factoring, bank overdrafts where there's a security in place, loans where there's a security in place. It is possible to restructure those outside the CVA, but the CVA is only designed for what is called preferential or unsecured debt. And at the moment in the UK, HMRC is preferential for value-added tax, VAT, for PAYE, for national insurance, for the employee, etc., and certain other things. But there are other bits of tax which aren't preferential. Everything else is unsecured, and the scheme can tie that debt in, offer a compromise, and that compromise is legally binding if the creditors vote to accept it. And we need 75% by value of the creditors who vote to be in favor of it for it to be carried, and then it becomes legally binding. It does include a court process, but the reality is on that given day where there's a meeting of the creditors, if they say yes to it, it is legally binding. And that can change the structure of a company's balance sheet quite dramatically.
And in terms of the part that you or KSA play, so do you come in and then do you negotiate that with the creditors, or do you take on a different role in the process?
Well, there are two parts to the process in the way that we do it. One is what we call the advisory process, where we work with the company, put together plans to reorganize the debt, look at affordability. We build financial models, very detailed models to test the various scenarios. We then would engage with the creditors on an informal basis and tell them that we are engaged by the company and that they should discuss the matters with us. We then put together a proposal. All of this is informal. We haven't had any formal process at this point. Once that proposal is ready, the financial forecasts have been agreed by the company and by us, based on the conversations with the creditors. Then it moves to the formal stage. And that formal stage is a filing of a report by an insolvency practitioner who is called a nominated supervisor. He is the proposed supervisor. He has to file his report in the court and attach a copy of the proposal. And when that process starts, that's the start of the formal process. 3 weeks later, typically, the creditors are entitled to attend a meeting, generally always done by telephone now, occasionally done by video, very rarely done face-to-face. And they will be given a form to fill in to prove their debt, and another form to vote for that debt, for, against, or they can abstain. A lot of people don't vote now, but that process is two parts. advisory at the beginning, then the formal filing in the court, a formal meeting of creditors, and then the binding process of a moratorium is put in place. So it's a very simple process in many ways, but where we differentiate ourselves from others perhaps is we spend a lot more time in the informal discussion phase. What we don't want to do is to impose an unwanted arrangement on creditors or landlords or employees or suppliers or whatever it might be. So yeah, it can take typically 2 to 3 months to put it together, during which time we're having dialogue with the creditors and the company. But we're not managing the company, we're not administrators, we're not liquidators, we're not general managers. Our job is purely to be advisors and to put together the best possible scheme to maximize the interest of creditors. And that last sentence is the most important in all of this. You've got to maximize the interest of creditors to get the best deal possible. Otherwise, the insolvency practitioner cannot act and the company wouldn't get approval by its creditors. The vast majority of CVAs are approved on the first meeting. Sometimes it can take a bit longer. So it's a very equitable process because the creditors decide. And if they say, no, we don't like that proposal, go back and do something else, then we can adjourn that meeting and go back and revise the proposal, which we don't like to do because generally it's one of our, it's our best effort. But that it might mean a higher payment to the creditors over a shorter period, or it might be a longer period. So the creditors can modify it, and then we go back and we have the meeting again. And if it's approved at that point, it becomes legally binding. And the supervisor is appointed by the creditors, interestingly. The big difference about this kind of insolvency is the supervisor supervises an arrangement. He does not supervise the company. So his job or her job or their job, sometimes there are joint supervisors, is to collect the money in that the company said it would pay into the scheme, agree the creditors' liabilities, and then in time pay them their money back. So it's a very equitable process, very clever process, and it means the company maintains its own direction. The directors are in control, shareholders are still shareholders, unless there's been some variation to that in the arrangement. So very powerful, very flexible, but very equitable.
And how difficult would you say on average it is to align the creditors' interests in practice?
You have two classes of creditors generally, and the first is HMRC, as I explained, who are preferential creditors. And the way the law is structured and has been since 2020 is those preferential claims of HMRC, for example, and there can be others, must be repaid 100 pence in the pound first. And then whatever is left goes to the unsecured creditors, which might be landlords, it might be suppliers, it might be creditors, it might be lending companies. They then get a smaller amount. So prior to 2020, everybody ranked the same. So if you offered to pay 40 pence in the pound to the creditors, that was the same whether you were HMRC or whether you were a supplier of nuts and bolts, for example. So it's a bit more difficult. Your question's a good one. A bit more difficult to align interests when HMRC's interests are in essentially preferential to everybody else. But HMRC are very sophisticated creditors, and they always take part. They always vote in the process, whereas a lot of other creditors don't. I'm not saying they're unsophisticated. I just think sometimes they think that there's not much in it for them. So the CVA, in law, there's no statutory minimum, there's no statutory maximum. But the interesting thing is once the CVA is approved, statutory interest does not get applied to the debt. That's terminated.
If you had to think of a case that's happened recently where you had to put a proposal forward, a couple of questions that I have is, one is, you talk about different financial models that you run. Doesn't matter how old the business is in that instance, to be able to basically write, a financial model for the future if it's only been trading for 4 years, 4 to 5 years or so.
Age doesn't really matter. It's about what the cost base is. Usually companies run out of cash prior to an insolvency, and the reality is it's generally because the costs are too high and the margins are too low. So what we can do with the financial forecasting process is to work out what costs need to be cut, what margins need to be varied, what level of sales we need to have. And if the model doesn't work, then we wouldn't put forward a proposal to the creditors. It has to be a viable model. Using case law, and various techniques that have developed over the years, it's possible to use the CVA to terminate employment contracts, terminate leases, rent, rates, terminate obligations to pay hire purchase arrangements, that sort of thing. So usually what I describe it as is we cut the cloth to fit what the level of turnover is and what the margin is. And there has to be a viable business. Otherwise, the thing can't get filed in the court and the thing will not be considered by the creditors. So what does viability mean? Well, it should be profitable in the future. It might not be profitable today, but it should be working towards being profitable in the scheme period, which can be anything up to 5 years, by the way. And the company has to repay something to the creditors, which would be a better outcome than liquidation or administration. So if we can't find a better outcome and we can't find a viable model, then the CVA will not proceed. It'll probably terminate and the company will go into a terminal insolvency, like a liquidation. So the age doesn't matter. What I always say in turnaround, the old turnaround phrase of people like me is, we are where we are, it is where it is, now how do we fix it? I'm not really all that bothered about how the losses were arrived at, and as long as they're stopped. And I'm not really too bothered about the history. I'm bothered about, is it viable today? Can it be viable over the next 12, 24, 60 months? Because if it can, it's better to try that pathway than to close it down and start again, which is called phoenixism. We're very rigorous in the forecasting process, and we've done this for thousands of companies over the years, so we know what to look out for. Um, but despite all those modeling processes and all the law and all the case law and the statute and all the rest of it, the directors have got to have a great deal of determination to make this work, because it is a tough process to go through. The company will not have any credit rating whilst it's in a CVA. So you have to consider what's the impact of that. If it's a trading company, for example, and therefore the cash flow has got to allow for pro forma payments, or we've got to generate enough cash to make sure that we can meet the costs of our suppliers post the CVA. So the modeling process is probably the most complex piece. In the same time, we've got to put together what's called a statement of affairs. And a statement of affairs is a legally required process to show what would happen if the company entered into liquidation, what the assets are likely to be worth in a liquidation, and what the likely outcomes would be for each class of creditor. And generally, liquidation will get a much worse outcome than a company voluntary arrangement. So that statement of affairs piece is legally required. The directors are supposed to put it together. We help them do it. But it's a model that can be the piece that takes the longest time, because we've got to make sure it's viable. There's no point in putting a proposal out there that says we're going to lose money for 3 years and then we'll be super profitable in 2029, because the creditors are not going to support that. They'd rather see the company closed down than that. So not every business is suitable for this process. I'm sector agnostic when I do my work. It doesn't really matter which sector it's in, because the process is the same. But it does matter sometimes if you've got a low margin, high turnover business where you can't change the customers, you can't change the product, you can't change the margin, you just haven't got enough customers. So you probably wouldn't progress with something like that.
What would you say are also some general misconceptions, perhaps, that business owners have when they think about going through a CVA?
The misconceptions are publicized by other people in the industry and in the sector, that CVAs generally don't work. My argument is the medical analogy is quite a good place to think about it. You go to a doctor to get help and maybe stop drinking so much and smoke less and eat better and do some more exercise, because your heart is going to be a problem in the future if you don't. You don't expect to be put into a box and taken out of there in a black car. So I always start with the diet and exercise approach. Can we do a deal that makes the creditors better off? Can the directors turn this thing around with our help? And if they can, good, that's where we'll start. But the misconception is CVAs don't work because a lot of them fail within a short-ish period of time. We did some analysis of a period between 2009 and 2022 of all the CVAs that we had written. And interestingly, Before COVID, 40 odd percent of them were successful. After COVID, that dropped like everything else did. But in that time frame, the CVAs that we wrote, there were 320 of them. So that's 320 companies going into an arrangement with their creditors. We generated 31 million returned to the creditors and 19 million pounds returned to HMRC. So you can see the thick end of 50 million pounds was returned to creditors that probably wouldn't have been returned to creditors in a liquidation. So we can counter the argument that CVAs don't work. The one thing about CVAs that people need to remember is it's hard work. And putting together an arrangement, reorganizing your company, letting people go, roles get made redundant. You might close down factories or shops or warehouses, whatever it might be. You might have to get rid of vehicles or boats or cranes. All of those things are stressful, and the directors need to have a good guide to take them through that. At the end of the day, if the company returns something to its creditors and it trades for a year or two and then it fails, well, they did their best. My argument is, they got a better return to the creditors than they would have done.
Another question that I have, because you mentioned that you are sector agnostic. So when you do the financial modeling, I'm just curious. So do you look at other companies perhaps in, again, comparable sectors to the company that you're considering? Do you look at the whole market? Do you look at maybe similar deals that you've done before? How do you approach that?
All of the above. But the reality is that if a director or a board of directors comes to me and says, we work in haulage and logistics and our forecast general GP, gross profit is 70%, I will laugh because that doesn't happen. GP in that sector is going to be 30% if you're doing well. So, we know the industry sector averages, but there might be exceptions to the rule. We did an example of a very good job we did that started as a result of COVID, actually, where it was a haulage and logistics company with two parts. The first part being a high-end distribution for a household name furniture maker who went insolvent in the COVID period itself. And it was delivering beds and furniture with two men in a van with white gloves on. Post-COVID, clearly that wasn't viable, so we shut that down. The other part of the business was working with Formula One, distributing parts, engines, vehicles, and what have you around Europe, and that was very profitable. After COVID the Formula One started again and COVID stopped, it immediately became profitable, and we put the company into a CVA, closed down the furniture distribution piece. 60 roles were lost. A large distribution organization down in Sussex was closed. We got rid of 30 vehicles. That business has just been acquired for quite a significant sum of millions, 3 years after a CVA was completed, four actually after it was completed. So the examples are there. We can point to these examples. We've just got to look at the sector and say, is it viable? Is this a declining sector? Is this a sector that's going to be impacted by changes to practice, process, AI, and so forth? So we're all sector agnostic, but we do know a lot about a lot of sectors because we worked in pretty much all of them. The process is a process. It's one that we take directors through all day, every day, and we're dealing with creditors every day. We deal with HMRC at least a dozen times a day, where we talk to them and say, this is what we're doing. So it's not for every business, but it's a very powerful tool if there is a viable business there, but it might just have too high a cost base. It might just have too many issues to deal with without going through this formal process.
What are some of the red flags that would indicate to you, perhaps if you are a business owner yourself, and then there's your business seems to be doing okay, but actually in reality it might be heading in the direction of a CVA. So what would you be looking out for if you were the business owner in that position?
We call them the warning signs, and they're fairly typical. One of the most important warning signs is arrears with HMRC. An ongoing arrears with HMRC. So they'll enter into an arrangement to pay back 100,000 and they get 20,000 into it and they start again. They can't meet the current obligations. That tells me the company's losing money. Directors failing to pay themselves through PAYE schemes is another red flag. That's because directors generally try and pay themselves the minimum for PAYE purposes, and then they take drawings and dividends. All very good tax planning if your business is profitable. If it isn't profitable, that means they owe money to the company, and in a CVA they have to repay it. HMRC will not support it otherwise. So that's another red flag. I think the most recent set of red flags we've been concerned about, and we forecast this back before COVID when we ran a series of seminars, was what I call alternative funders. Very easy to go and raise money from alternative lenders nowadays. In the old days, if you had a bank manager relationship, you went to the bank manager and asked for an overdraft of £50,000, he would say no. Now you can raise £50,000 on your phone probably within 20 minutes if you're a director of a company with more than a year's worth of trading. And so what we've seen happening over the last 3 or 4 years is multiple lending scenarios into a small to medium-sized company, which are robbing Peter to pay Paul. So we did a chartered surveyors firm recently where he had 7 alternative funders. I won't name the names of the funders, but online lenders. And each time he took out new money, it was to pay the interest back on the old ones. And it became a self-defeating spiral. We put that into an informal arrangement, very like a CVA, and that has protected the business. But those are red flags. The key to this is not believing the business numbers. And when the directors are saying we're profitable, well, why are you borrowing all this money? If you're borrowing all this money, it's to stop the hemorrhaging of cash. So if you're not generating cash, you're not profitable. That's why you're going out to borrow more money. So how do you convince me, Mr. Director or Mrs. Director, that the business can be viable enough to generate a proper salary and income for the people involved, to pay money back to HMRC and to the creditors, and to adhere to the rules of the voluntary arrangement? And that culture shock we've got to go through with pretty much every client. They don't really understand why they've run out of money. Generally, as you would know, it's P&L based. The profit is not as big as the loss usually. But it isn't profit and loss and balance sheets that kill companies, it's cash flow. And it's when the cash runs out that typically somebody takes legal action. So the final red flag is if they've had multiple actions, multiple scenarios with HMRC, they will get action taken against the company by HMRC. And if that's a winding up petition, then it's very much more difficult to do a CVA. It's still doable, but it's very much more difficult to get a restructuring in place quickly enough to deal with the winding up petition scenario. Typically, we will go to court and ask the HMRC to postpone the winding up hearing, but the reality is that tells me that the directors have kind of left this too late. Why have why has HMRC lost faith in what you're doing? It's because you regularly are not paying taxes on time, and you're using that as a tertiary bank, if you like.
If it's a winding up petition from a different creditor, so not HMRC, so maybe some creditor who is perhaps to some extent less patient, although I don't think HMRC are that patient. So is it also too late then to go for a CVA, or it's still salvageable?
It can be salvaged, but a couple of interesting points about the winding up petition. Number one, the issuance of a petition to the court and then to the company is actually the commencement of liquidation. And 99% of people don't understand that. And what happens is the petition has been filed in the court has granted it, it then gets served on the company. Sometimes there's a big gap between, but credit rating agencies will notice this, and they will put a notice up to say that the company's had a winding up petition. The point is the company's liquidation has already started, so we've got to try and reverse that. And the only way you can reverse that is to get a well-structured CVA approved by the creditors. We can ask a petitioner to postpone, so we can ask for an adjournment from the courts. The courts take a view that you have to have a pretty well progressed CVA before they will let an adjournment occur, because anybody can go to the court and say, oh, I'm going to do a CVA. Well, show us evidence that the work is being done, the work has been done, you're working with a credible advisor, insolvency practitioners, and so forth. Often, though, and it shouldn't happen, but often winding up petitions are used liberally by debtors to chase cash in, and sometimes they're not valid. But generally, if it has been issued, the company needs to go to court. The company needs very specific legal advice, which we don't provide because we're not solicitors. And it needs to put together a proposal quickly which is viable, or it needs to pay the debt that the petitioner is petitioning for. And that debt could be substantial. Typically with HMRC, though, they will, if we go to them and say, look, we are engaged, we are putting together a CVA, and we do think that it can be done in the next few weeks, HMRC will agree to an adjournment because they do definitely want to see the company survive and get their money repaid through a CVA somehow. But we've seen situations recently where there's been three adjournments of a winding up petition from HMRC, and we've gone back to HMRC and they said no, the company needs to be wound up.
Hmm.
It's about relationships as much as anything else. You know, if the company is adhering to the rules and paying the taxes and then asks for time to pay because it's got a cash flow problem, HMRC will be supportive generally. It's when it's happened for a couple of years that they tend to lose patience.
And with business owners, just to rewind back to something that you said about having that conversation with business owners, kind of changing the mentality around, what they've been borrowing, how they see their profitability, so to speak. If someone told you that, okay, yes, we are borrowing quite heavily, but it's because we're going through a growth phase, what do you say to that to them?
Demonstrate the growth to me. And yes, one of the questions we always ask is, what is the working capital requirement for this business going into a CVA? Because it might still be on that growth pathway and still needs to grow to get to critical mass, but you're not going to be able to generate a lot of new capital when the company's in a CVA because the company has no credit rating. So there's a delicate line to tread there to say, look, maybe we need to just pare back the growth plans a bit. Maybe we've taken on cost, and I see a lot of tech companies, a lot of seed-funded companies like that, where they've taken on the roles of CEO, CFO, CMO, and all of those things well in advance of actually having enough turnover and profitability to support, because their funders are saying, let's go for growth. What we tend to do is say, let's stop going for growth so much, let's pare back the roles and the costs. And we don't have to be a £100 million turnover business. We need to be a three, four, £5 million turnover business making some money. Because if we can do that, we've got a viable business. That's anathema to many high growth company directors who think, I'd rather just go and raise some more money. Good, carry on doing that. We're not going to work with you if you can't understand the process of restructuring. And the whole point about what we do is it's restructuring. We don't carry on doing what they did before because it patently didn't work. So it's a case of doing something different. Remember my phrase, we are where we are, it is what it is. What do we do now? Well, we've got to do something different. And indeed, it's fascinating. A long time ago, I met the head of the HMRC recoveries department, and he said, Keith, we'll support CVAs in the main, but we need to know what's going to be different. If we carry on going down the same path that didn't work, that's madness. We're not going to be supporting that. So, yeah, the mentality, your question is a very good one about the mentality of directors who insist in many occasions that they don't need to do a CVA, don't need to be insolvent. Company isn't insolvent because I can go out and raise more money from my investors. Why have you got a winding up petition then?
Mm. Mm-hmm. Yeah.
And that speaks to the definition of insolvency. The three definitions of insolvency for a corporate vehicle are: balance sheet insolvency, is the balance sheet solvent or insolvent? That's one test. The second test is legal actions. Are there any CCJs or any petitions or writs? But the third one is the one which knocks people down when I say to them, look, the company fails the insolvency test called cash flow. And I've lost count of the number of people as directors who said, Keith, we've got a time to pay arrangement. That means we're not insolvent. No. The very fact that you're in a time to pay arrangement with HMRC is exactly indicative of the state of the company. It's insolvent. It's only by the grace of HMRC that you're allowed to pay that money back over a longer period of time than the law requires. Again, we tend to fall out with a few people on that one because they don't believe that the company's insolvent, even if all three tests have failed.
One of the things that you've mentioned a couple of times as well was where some contracts get terminated. I think for any business owner, that's one of the biggest pain points, I guess, as well, having to let go of some people. So my question is, when you talk to them about it, how do you advise them on it in terms of preserving that nucleus of people who can keep the business running? Because, when everything is growing, that's great. But when there's a CVA, when a company is potentially going into liquidation, people batter the ship sometimes. And so how do you go about that?
Well, it's not about people, it's about roles. What we need to look at is if we've got a business which is going to do 2 million turnover next year and we've got 2 million of costs of people, clearly that's not viable. So we then go through all of the roles, what roles are required, which roles are not required, can we outsource some of those roles? And then we guide the directors through the costs, put that into we have a very sophisticated financial modeling tool. We put all the roles in, what the roles cost, what the likely growth in wages might be over the next 1, 2, 3, 5 years. And then what we do is we identify in each department how many roles aren't required. I don't know the names of these people generally. It's a case of doing a detailed financial forecast and saying, do we need 7 people in marketing when our growth is only going to be 5% a year? No, we probably need 1. You see what I'm saying? So you attack the cost base first, and then you look at what the roles are, and then we agree what the redundancy process needs to be. And interestingly, if the CVA is approved, their redundancies and lieu of notice payments will be met by the government to a cap. They don't get the full extent typically, but they will generally get up to £700 a week. So it's a case of a unemotional. We're not emotional about the business. The directors and shareholders clearly will be. It's a case of going through the roles, building a viable model, and saying how many people and how many roles do we need, and then they have to go through the consultation process with those roles that are being lost and the people that are leaving the organization. We tend to help with that as well, although we're not HR experts. We do know how the government's schemes work. But that's the negative side of what we do. I think the worst day of my career was letting 605 people go from one organization in one day. There was quite a long piece of work running up to that process, but it can be 2 or 3 people, and there could be family members. That's not the enjoyable part, but the gratification is that the company then succeeds, gets into a CVA, and 5 years later, people are doing quite well. The business is growing, it's paid off its CVA, and it's moving forward. A lot more don't. They might end up in liquidation. That's just the nature of this beast, I'm afraid. They can't all be saved. So we always use the expression the directors must check the emotion at the door, because what we need to do is look at this in a purely analytical way, look at the forecasting, build a viable model, and then how do the roles fit? Same applies, incidentally, to costs like landlords and properties. We did a pharmaceutical manufacturer last year, and it had 3 factories that only needed 2. And the third factory was £980,000 a year of rent and rates. So we handed that back through the CVA process to the landlord, taking £1 million of cost off the P&L straight away. That was using the CVA process very carefully.
Do you have an example, perhaps, again, without maybe naming names, but let's say there's a company that's gone through a CVA review, let's say 5 years ago, you said, on ever, sometimes it can take 5 years, where at the end they actually ended up, achieving higher growth after a CVA and achieving the turnover, the margin figures that they wanted to achieve?
Yeah, we've got a number of examples in the software sector. I mentioned one before about haulage and distribution logistics. We've got examples there. Probably the most striking example is what I would call a personnel business. This is an umbrella company, which at the time we dealt with it was turning over 100 and something million pounds, 109, I think it was. We cut that back by restructuring the business to something 2/3 of that level. It had 3,000 staff under an umbrella process. So they were working for the health service or they were working for the education sector, but the umbrella company provides a service to deal with PAYE, national insurance, and employers' national insurance, that sort of thing. That company now turns over £1.3 billion, is probably worth a few billion, and the CVA was clearly a successful point along the pathway. I'm not saying that we're responsible for the growth, because we clearly weren't, but what we did do is facilitate a restructure that led to that business growing very rapidly. And HMRC liability on that one was £11.1 million, because it was all people costs. There were very few premises costs. There were no suppliers. HMRC voted for the £11 million, having issued a winding up petition earlier. So that was a very successful case, but demonstrably good management, and they were able to generate new capital. They went through a series of funding rounds. I think at one point they were thinking about going onto the market. That hasn't happened, but it's still owned by the same family, and it's doing incredibly well. The biggest mistake I made, I think, there was not getting an equity stake in the business, because that would have been quite nice.
Yeah. When you
Not
say
that
that,
we're allowed to, by the way. We can't take equity stakes in these businesses.
I was about to ask about that. Yeah, but I also had a question. You said that they went from, you basically cut it in, down to a third of, it was third of
That's
revenue
down,
that they
yes.
were generating, right? Yeah. So okay, interesting. And then in terms of the in terms of them going on market, you mean like them going public essentially?
Yes.
That was the idea, right? Okay.
But that didn't happen, and it was acquired, I think, or partially acquired by private equity. So they were a very successful scenario. But the day the winding up petition arrived from HMRC, I was sitting in their boardroom, and it was a shock to all. It wasn't a shock to me, because HMRC are very, they were pretty aggressive beforehand, because this company had been in lots of deals with HMRC over a period of 9 months or a year. And because it's very high level of people costs, it's a very high level of pay as you earn and national insurance deductions, which weren't being paid across. So they issued a petition. We convinced HMRC to adjourn the hearing, and we got the CVA approved. And reality was HMRC voted for it. Different departments in HMRC to the people who issued the winding up petition. The department that deals with these things is called the Voluntary Arrangement Service, who are separate, if you like, to the debt collection, debt management processes. And their job is to assess a scheme. Does it look appropriate? Is it fit? Is it fair? Is it feasible? Is this the best recovery for the taxpayer? If it is, we'll support it. If we don't believe that it's fit, fair, and feasible, we won't support it. So they are, we deal with them every week, and generally they're supportive of CVAs.
When you say that they had a demonstrably good management, how do you judge it? Because obviously the company was in trouble at the time when your services were acquired. So do you mean as in terms of the growth that they achieved, or what are the factors that you consider when you say it's a good management team?
Well, there was a core of a good management team which had been brought in by the owners in that case, and the owners were in their 60s, like me, and they were chartered accountants. And they weren't really focused on the business, and they'd brought in professional management, which is the best thing they'd done. And the owners left the table, and the younger management team drove it forwards. And interestingly, most of the management team that were there then are still there now, and they're doing jolly well. But the reality was, it was my job to say, this isn't working, and if we're going to do this, we need to back the management that you brought in.
One question that I have is also when we get a lot of inquiries from people who are looking to buy distressed businesses with the view that, look, I can turn around a business and make it a success. I suppose there are a couple of questions there. First of all, I suppose if you had to take the task on yourself, looking at a distressed business and trying to turn it around, would you approach it as you do now with CVAs, in terms of just stripping it down to basics, making sure the basics are right? Would you perhaps do something else as well to make sure that the business is growing as well? Or again, maybe there's a mixed solution there?
I think there is, and it's case specific, sometimes sector specific. I would be very careful on the basis of acquiring a company which is in distress without it going through some form of process. Now, that doesn't have to be CVA. That could be an administration process or a pre-pack administration process. Acquiring a business piece or a section or a division could be doable through what's called a business asset sale. Typically, that's best done through either a CVA, but more likely a pre-pack administration. So what you don't want to do buying distressed businesses is to take on the history of the debt. You don't want to take on the debt itself if you possibly can. And you've got to have a clear view of what the business can do in the future. The work that I'm doing with these clients is quite important for that, because we're looking at it through an insolvency practitioner's eyes. I'm actually not an IP, but we have a number of IPs. But you're looking through that prism and saying, can we make this business viable? And there are occasions where we look at it and think, ideally, what it needs to be is part of another organization, or it needs to bring in external investment. So we've just done a brewery group where there are now 600 shareholders, and a number of share issues were done on before the CVA process, and then probably there will be more afterwards. But what we did was we tidied up the debt, and there was a fairly substantial debt. So the caveat emptor rule applies when a company's insolvent. You go and buy the share cap, you take on all the liabilities, and then you've got to deal with it somehow. So you're probably best speaking to insolvency practitioners like us, or there's lots of great IPs out there, and they might say, look, we can parcel this up and we can sell parts of it off, or we can sell you the whole thing, but it's going to be without the debt. But you've got to have the working capital as the acquirer. You've got to take on, in general terms, you've got to take on the employment costs. You may have to do deals with landlords and what have you. That's all very complex. But a CVA is a less onerous way of doing that. And we've done a number of situations where people have acquired businesses out of or after a CVA has been approved by the creditors. So it can be done. Often, though, I'll be quite careful in how I say this. I would like, if somebody's approaching us to talk about acquiring a business, I would like to see that they've got experience in that sector. There are a lot of people who phone me up and say, I want to buy an insolvent business. And I say, what experience have you got and what sector are you looking at? Oh, I don't mind. The conversation doesn't go very far from there. If you've got people who are like the recruitment story, if they've got very good expertise in recruitment personnel, if you've got people who are manufacturers and we've got a manufacturing client, then those conversations can be quite fruitful. Often that'll turn into an admin pre-pack and they'll make a bid along with other people. But general inquiries, I'll get them 4 or 5 times a week saying, I want to buy an insolvent company. We don't really pay much attention to that because the reality is most of the clients we're dealing with are SMEs and probably family owned or small shareholder groups. And our job is not to sell the business out from under them. They're the ones who have worked hard to get it to there, and they're the ones who are hopefully going to drive the recovery. At times, it happens. Every case is different.
And with CVAs, a less pleasant question. So, do you have an example of where a CVA took place, seemed like everything was on track, didn't work out for the business? The business still had to go through, let's say, liquidation at some point, or something, something just didn't go right. And perhaps the follow-up question to that is also, what usually goes wrong? Why do CVAs not work at the end?
The first question is, I'll give you an example of a software company working in transport. And its biggest customer was Network Rail. And before and after the last election, Network Rail suspended investment processes with this company, promised they would turn them back on when the new government was in place. They did to an extent, and then they turned them off again. I'm not going to be very more specific than that. And that CVA has lasted about 13 months, but the work has dried up. Network Rail being 60% or so of their business, but the work has dried up everywhere else as well. And that might speak to greater market pressures and nothing to do with my client. But the fact of the matter is that's now going to go through a liquidation process 13 months after a CVA was approved, which is disappointing. But the director's a pragmatist. He's the only shareholder, and he's realized that he can't buck the trend of the marketplace. And the second question about what are the usual causes? Well, there are a whole lot of causes. Management repeating their mistakes is one of the common ones. Carrying on as before. Not having credit can be problematic. So quite often we'll look at restructuring these things into group structures so that we can obtain credit in the group as opposed to the specific company in a CVA. But markets change. And if your biggest customer or some of your customers decide not to deal with you for whatever reason, it could be that it's the company's in a CVA, which, bear in mind, is in a public domain event, right? It's that company's house. It's registered there. So a whole variety of things. But our job is to try and pre-plan for that. But the reality is, every business is reliant upon its customer base, whatever that may be. And if the customer base changes or declines or goes in another direction, or a new competitor comes in at half the price, the CVA is irrelevant then. It's just a case of that the market has spoken. if you like.
The crossover I see here is that with a lot of businesses that we deal with, like sometimes when it comes to the valuation, one of the key factors that affects it is customer concentration. If you're over reliant on one main customer, even if it's the government,
Yeah,
then there is a higher risk that things will go
most
wrong.
definitely. And contracts are not worth the paper they're written on, is the old phrase, isn't it?
Mm.
But another scenario you've got to look at with CVAs and or with pre-pack administrations is if you're dealing with the government, um, they have what are called PQQs, pre-qualifying questionnaires, before you even start to tender for work. Is the company insolvent? And if the company is in a CVA, it is technically still insolvent. And so that becomes a hurdle. So you start looking at group organizational structures, and you'd start tendering for work in different ways, possibly. But the company might just be too small for that. The business might just be too small for that. And again, going back to the first point that I responded, management often don't change their spots. So we've got to make sure that um, they're getting good management information. They've got good, maybe a fractional finance director, CFO. They've got up to date information. They know what they're doing, and if the market changes, well, it's not really so much their fault. Too many directors just hand the accounts to the accountant at the end of the year, out of Zero or Sage or a cardboard box full of invoices, and say, "Do my accounts." Nowadays, that's just not good enough, and we wouldn't be working with clients like that.
Keith, I've taken up quite a bit of your time, but I want to ask just one last question. And I'm just wondering, you've obviously been in the field for a number of years now. And nowadays, do you see an increase perhaps, in the last couple of years in CVAs in terms of, businesses coming to businesses that are struggling as well? And does that make you worried at all about the business climate in the UK?
It's a bit mixed, really. Um, I think what we've seen over the last 2 years is an increase in the number of formal insolvencies. And the statistics will back that up. They're at a fairly high level, but they're still at a low level in comparison to the overall stock of companies. Fewer than 1% of active companies go into an insolvency process. The scenario that I've seen over the last 2 or 3 years, and we've kind of driven this as well, is in quite a number of cases, probably getting on for half, we don't go down the CVA pathway, we go down an informal version of it. So we will go to the creditors and say, look, we could file a CVA, we could look at a pre-pack administration, the company might go into liquidation, but if you were just to work with the company and with us and give them, say, 12 months to repay your debt, we can avoid a formal insolvency altogether. So the last couple of years, about half of our work, probably in value terms, has been what we call TTPs or time to pays. If you can't persuade the creditors to go down that path, then you move to the formal process of CVA. In terms of the type of companies that we work with now, we've spent 30 years developing this craft and these techniques and learning the craft of CVAs, and we still learn every day. The reality is, for very small companies, it's just not cost effective. Having said that, if they've got the OHMRC a couple of £100,000 and other creditors a couple of grand, that's you could still do a CVA there. It's the wider picture that we look at: is the management competent? Do they have financial information? Have they got management accounts? Do they understand what a balance sheet is? Do they understand their cash flow? Do they actually have a cash flow? If all of those things exist, then we're happy to get on and roll our sleeves up. If they don't exist, I don't think you're going to change those spots. The leopards are not going to change their spots if they carry on doing the same thing. So we've become a little bit more careful in the jobs that we take forward to CVA, I would say. So, actual fact, the volume of CVAs that we've done over the last 2 years is down, but the value of the debts is significantly higher. The bigger organizations. But we've done a lot of time to pays. We've done 2 time to pays recently for companies turning over £50 million, where we avoided insolvency altogether. So it's the same skill set, it's the same work. It's just not filing something in the court. It's just not calling a meeting of creditors. It's the Damoclesian effect of saying we can do all of that, but if we can just get an informal arrangement in place. We did a law firm, quite a large conveyancing firm, turning over 13 million a couple of years ago, where HMRC and bank debt was about 4 million, and it had 13 properties. It only needed 6. And we managed to do a CVA without doing a CVA. We didn't file the CVA, but we did all of those things by negotiation. And we can be very persuasive. We present a statement of affairs, we present the forecast to them and say, look, here's what will happen if it goes liquidation and CVA. Here's what we're offering you, which is 100 pence in the pound. But it might be over 36 months. And in that case, that company is still going along very well today, probably one of the largest of its kind in the country. That was an informal CVA. Now, you won't find that on the internet and you won't find that in the statute, but it's essentially what it is.
Yeah, I mean, at the end of the day, the terminology can change. From a legal standpoint, it might be different, but if the process is similar, then and it works, then why not?
And I think the adversarial nature of creditors and debtors has changed a lot over the last 10 years, particularly since COVID. And I think, there was a lot of largesse from the government. A lot of landlords helped a lot of companies out where they wouldn't have done in the past, maybe. HMRC was more, forbearing. The reality is, if we go along and say they want to pay you 100 pence in the pound, it's just that they can't do it today or tomorrow or next month or even this year. We're licensed insolvency practitioners. We've looked at those options, and we think the best option is to get paid 100%. But your classic creditor, it's going to be 24 months, for example. Mm-hmm. And we've got a lot of deals running like that. The fallback might be if market changes or they lose a customer or things go wrong, that they go down the formal pathway the next time. And that might be CVA, administration, or liquidation.
Thank you very much for this. I don't want to take up too much of your time, but that's been very insightful. And I'm sure it was very insightful for all the viewers as well.
Well, let's hope so. Anybody's got any questions, they can find me on LinkedIn.
Wonderful. Thank you.
But the value of the debts is significantly higher, the bigger organizations. But we've done a lot of time to pays. We've done 2 time to pays recently for companies turning over £50 million, where we avoided insolvency altogether. So it's the same skill set, it's the same work. It's just not filing something in the court. It's just not calling a meeting of creditors. It's the Damoclesian effect of saying we can do all of that, but if we can just get an informal arrangement in place. We did a law firm, quite a large conveyancing firm, turning over 13 million a couple of years ago, where HMRC and bank debt was about 4 million, and it had 13 properties. It only needed 6, and we managed to do a CVA without doing a CVA. We didn't file the CVA, but we did all of those things by negotiation. And we can be very persuasive. We present a statement of affairs, we present the forecast to them and say, look, here's what will happen if it goes liquidation and CVA. Here's what we're offering you, which is 100 pence in the pound. But it might be over 36 months. And in that case, that company is still going along very well today, probably one of the largest of its kind in the country. That was an informal CVA. Now, you won't find that on the internet and you won't find that in the statute, but it's essentially what it is.
Yeah, I memean, at the end of the day, the terminology can change. From a legal standpoint, it might be different, but if the process is similar, then and it works, then why not?
And I think the adversarial nature of creditors and debtors has changed a lot over the last 10 years, particularly since COVID. And I think, there was a lot of largesse from the government. A lot of landlords helped a lot of companies out where they wouldn't have done in the past, maybe. HMRC was more, forbearing. The reality is, if we go along and say they want to pay you 100 pence in the pound, it's just that they can't do it today or tomorrow or next month or even this year. We're licensed insolvency practitioners. We've looked at those options, and we think the best option is to get paid 100%. But your classic creditor, it's going to be 24 months, for example. Mm-hmm. And we've got a lot of deals running like that. The fallback might be if market changes or they lose a customer or things go wrong, that they go down the formal pathway the next time. And that might be CVA, administration, or liquidation.
Thank you very much for this. I don't want to take up too much of your time, but that's been very insightful. And I'm sure it was very insightful for all the viewers as well.
Well, let's hope so. Anybody's got any questions, they can find me on LinkedIn.
Wonderful. Thank you.